Have you ever wondered why your support and resistance levels don't get respected? Don't worry, in today's video I will help you guys to solve this problem. Most traders think that once they are able to identify support and resistance levels on the chart, and once they are able to do a decent technical analysis, that they should turn profitable in a moment. But that's not the truth, because if it was that simple to simply determine a support and resistance area and to put your entry below a resistance area or above a support area and then put your stop loss above a high or below a low, if it was that simple to make money, everyone would be profitable, right? But that's not the case, because if someone is making money, there's always the equal amount of people losing the equal amount of money to pay for that individual's profit. Otherwise, it would not be able for people to make money if there's no one paying for that person's profit, right? If trading was that simple, then everyone would be profitable, but that's not the case. And in today's video, I will explain to you guys how you can make sure that your support and resistance levels do get respected and how you can make sure that you become a profitable trader. We are going to discuss two things that will make your support and resistance levels work. First, I'm going to discuss market structure with you guys, because this is where so many people fuck up every single time. And then afterwards, we are going to talk about liquidity and why liquidity is so vital in order for your support and resistance levels to work. Let's start off with market structure, guys, because so many people don't understand that they are trading against the trend and that they are not able to identify valid support and resistance levels. In order to make them work, they need to be able to identify the valid market structure shifts. Guys, what we see over here is not a valid market structure shift. What we see over here is not a valid market structure shift. Why are these not valid market structure shifts? Because in order to get a valid market structure shift, the price needs to break above a significant high in order to get a valid bullish market structure shift, or it needs to break below a significant low in order to get a bearish market structure shift. Now, when do we get a significant high and when do we get a significant low? That's the question that people are wondering. Guys, you get a significant high once a high, like we are seeing over here, for example, the high over here brings you to a fresh low compared to the low that brought you to that high. This high over here did not bring us to a new low compared to this low that brought us to that high, so it's not a significant high to break. Now let's say that we formed this high over here and that high brought us to a fresh low over here compared to this low that brought us to that high. And guys, this can be wicks, this can be candle open and close, this can be candle closing, it doesn't matter. If the price is wicks below the low that brought us to a high, the high all of a sudden becomes significant. Now if then the price breaks above this high like we see over here, then we are looking at a valid bullish market structure shift, because now the price is breaking above a significant high. But important to realize that a wick in this case above that high is not enough. No, we need a candle open and candle close above the significant high or below a significant low in order to get a valid market structure shift. So if this trend and this price action is visible on the 4-hourly time frame, over here you need a candle open and candle close on the 4-hourly time frame above this high that brought us to this fresh low compared to this low that brought us to that high. Alright, so you can see it's basically some kind of a triangle, as you can see. Now in order to determine a significant low, on the other hand, we need the low to bring us to a fresh high compared to the high that brings us to a low. In this case, this is not a valid break of structure yet. But if this low brings us to a fresh high compared to this high that brings us to this low, then all of a sudden this low becomes significant to break. Now if you then get a valid market structure shift to the downside, and if you then determine support and resistance levels, you already have a higher probability that your support or resistance level will work. Why? Because in that case, you're trading with the trend instead of trading against the trend. And this is the mistake that so many people keep on making every single time, guys. First, determine the trend on the daily time frame and the trend on the 4-hourly time frame. Those need to align with your support and resistance levels in order to work. So at the beginning of the video, I gave you guys an example where a resistance level didn't work on Bitcoin because the liquidity and the market structure weren't aligning. But over here, we can see that we have a significant low. Why do we have a significant low over here, guys? Analyze the local structure. This low over here, right, brings us to a fresh high compared to this high that brings us to this low. So it becomes a significant low to break in order to flip the trend to the downside. Then price goes beneath that low. Over here, we can see that we open and close multiple candles below that significant low, so we get a valid market structure shift. Now we can determine a potential resistance area in which we can see that we have a key level over here, for example. If we then put our entry at that resistance area and we put our stop loss at the high that brings us to this low that broke structure, and we, for example, put our take profit target at this liquidity that we have over here, now we can see, if we then play the chart, guys, that the entry does get filled and that the entry does get respected, and that afterwards the price goes eventually towards a liquidity pool. Now, is that a coincidence? No, it's not, because the setup is quite similar compared to the setup that I showed you at the beginning of the video. But at the beginning of the video, we didn't see a valid market structure shift to the downside because we didn't break below a significant low. Now, this setup works as well for one more reason, and that reason is because of liquidity. In order for your support and resistance levels to work, there's one more reason why they work, and it's called liquidity. Guys, with your support and resistance levels, there needs to be a certain alignment of a certain liquidity pool. So if there's no liquidity aligning with your support and resistance level, there is no way that the support or resistance level is going to hold. Now, why is that, guys? Get into the mind of the market makers, get into the mind of smart money, and try to get outside of the mind of retail traders that simply identify support or resistance level, put their entry on top of below it, put the stop loss, and then think that the setup works. Guys, if smart money or the market makers are not able to fill their orders at a support or resistance level, do we think that the price will reverse to the upside or to the downside from off that support or resistance level? Obviously not, because smart money is what drives the market. The bigger money inside of this market is exactly what is pushing the market to the upside or downside. If they don't have the opportunity to fill their orders at a certain level of support or resistance, why would the price reverse? If smart money cannot fill their orders, how are they going to reverse the price to the upside or to the downside? Now, in order to fill their orders, they need to have a certain liquidity pool, because if they want to buy millions worth of a certain coin, millions of people have to sell to them in order for them to be able to buy, and that is what they can do inside of these liquidity pools. So if you have this valid support or resistance level based on market structure, also need to have a valid front run of that support or resistance level. Not only a valid front run, but that front run, what we call an inducement, needs to be a valid inducement. There need actually people to be putting their stop above this high in order to have liquidity here, right? Obviously, liquidity also consists out of unfilled orders, but if we don't have stop losses resting above this high, there's not enough liquidity for smart money to fill their orders. Now, in order to determine a valid inducement, you want price, after front running a certain resistance or support level, to put in a fake break of structure. We know now, after the previous market structure lesson, that we are looking at a fake break of structure over here. Why? Because this low did not bring us to a fresh high compared to this high that brought us to that low, so it's not a significant low to break, so it's rather a fake break of structure. But retail traders think that this is a valid break of structure, so they break down short the price of Bitcoin, right? And after breakdown short in the price of Bitcoin, they put their stop loss above this high, and then they target lower levels over here, or they pull back short the price of Bitcoin or any other altcoin. The point is that they are shorting because of this fake break of structure, and they are putting their stop above this high over here, now creating a valid inducement exactly where we have our resistance area. If then the price reverses to that resistance area, we have an A+ valid short setup over here, and we can expect the price to respect this resistance area, reject off our entry point, and push it to the downside towards our take profit target. That is exactly what was happening on the Bitcoin setup that I just showed you guys, and that I will show you guys one more time to explain how important that liquidity was in order for that setup to work. So guys, we had this short setup that marked the all-time high currently for Bitcoin. Now, if we look at the local price section, what can we see over here? We see a fake break of structure, and that fake break of structure over here is making people break down short the Bitcoin price and put their stop above this high or anywhere inside of this imbalance over here. So what is this causing? It is causing a liquidity pool to exist over here above that high that brings us to that low over here. It is causing a liquidity pool to align with our key resistance area. So now we have an A+ setup because we have market structure that aligns with our entry, and we also also have liquidity that aligns with our entry. Is it a coincidence that once again the price respected resistance area right now? No, it's not, because we had the market structure that aligned with our short entry, and we have the liquidity that was also aligning with our resistance area and our short entry. So guys, this shows to you how important it is to not only be able to identify support or resistance levels, but to have a clear understanding of how the market moves and why the market moves to a certain direction every single day. If you don't understand market structure, you don't understand liquidity and how to identify valid market structure and valid liquidity, your support and resistance levels simply won't work.